Hi, everybody. Welcome to Entrepreneur. I am Jillian Sidoti, your host. Hostess. I am doing the interview this week. It's no Nate Dodson. It's just me, Jillian, and I get to be with all you lovely people today on the Entrepreneur live stream, live on YouTube on Tuesdays at 1 p.m. Eastern, or what is that, 10 o'clock Pacific, and Nate's in Central Time Zone, so noon Central. I'm in Atlantic Time Zone, so it's actually 2 o'clock here, 2:02 to be exact. Not that you asked or care, but I get to do the interview today, and I'm super excited because today's interview is all about what most of you love, which is real estate. I know so many of you out there are real estate, and what I always say is there's 2 different types of people, right? There's people who are in real estate and invested in real estate, and those that wanna be. So which one are you? Maybe if you're one of those that wanna be, you can actually become a real estate investor after today's interview because I am interviewing Ray White, who's a dear personal friend of mine, and he's been in real estate for over 20 years on the institutional side, and he's done over 146 transactions that total $8 billion in deals. So get your questions ready. You're not going to have another opportunity like this to ask somebody the big questions regarding real estate investing, like with somebody who has the experience that Ray does. So let's get to it. All right, Ray, welcome, welcome. Thanks so much for being here today.
Thank you. Thanks for having me. It's 11 a.m. in Denver, so you skipped that.
How can I do that? How can I have it so that I name every time zone except the one my guest is in? That's pretty bad. That's pretty bad. But
Not a problem. Not a
let's
problem.
forge ahead. Let's pretend I didn't make that very bad social faux pas. All right. So listen, you've been in real estate for over 20 years, so that's a really long time. I'm assuming around you got in before the last bubble burst. Is that correct?
Yeah. I participated in that one. I have good memories of that one. Yeah. So technically, my first job was probably '99. Um, not it was as an asset manager for a large real estate holder, but I really got into the transaction side in about 2004. So yeah,
So right before. Yeah, so
right
you were
before.
in there. That's the same time I got into real
Yeah,
estate was 2004 and everything seemed amazing.
yeah. Well, in Colorado, you had just so I was in Denver, and you had the tech bust, which hit Colorado pretty hard, and so I kind of went through that, and we had brand new developments that were giving away 6 months free on a 12-month lease, and
Wow.
it was just all the way they were selling everything. So you thought you had seen the worst, in that you're giving away half of your rent. Um, but yeah, then 2000, we kind of felt the first ripple, and I'm sure you did too. I kind of felt the first ripple in 2007, but then everything kind of fell off in 2008. So
Wow, wow, wow. So, that's a very interesting 2004 was definitely a very interesting time to get into real estate and then watch everything crumble. I remember it being a time of great anxiety, but then I also remember, between 2008 and 2010 in particular, a great time of excitement and
mhm,
opportunity.
mhm.
Where do you think we are based on that experience? Where do you think we are right now in the cycle? Like, are we headed towards another 2008 in your opinion?
No, I mean, I think, from my point of view, so transactions have kind of ceased, or certainly reduced. I don't think we
Mhm.
are, but people just don't know what to think right now. You've got buyers and you've got sellers, but
So you
they're
think it's
just a
more of a
little,
fear situation?
yeah, they're just a
Yeah.
little too far apart, and people are just not willing to take the next step because there's just too many questions out there still. There's still,
Mhm,
again,
mhm.
there's still people who want to buy, there's still people who want to sell, but they're just a little too far apart at this point. And there's deals. So I mean, from the positive standpoint, there's deals have picked up. Um, but certainly not to the level they were 2021. When, I mean, if you probably call 2021 the peak, at least half the year, you're certainly still not at that pace.
Mm-hmm. Okay, so do you think that people are making a mistake by sitting on the sidelines right now, or do you think it's too hot and people are being properly cautious?
No, think I think the buyers want to buy.
Mhm.
They just can't make the connection. So uh, I guess the question is should the buyers be stepping up to the sellers' prices? Uh, that's a tough call. I mean, it depends
Mhm.
on the property. It depends on the location. It depends. There's a lot of variables there. Good real estate is still going to trade, and it has been.
Yeah.
Locally here, we've seen an uptick in deals, and deals are getting done, and the deals are getting done at sub five caps. Still, it's just the velocity that was in the market in 2020 and 2021 is not there today. So I don't know. I got a lot of broker in me, so I
So
know
you're
better.
like, "Sell,
Well,
buy."
I know better than to say you should just pay a little. Look, I mean, for a long time, I said, you gotta get in to get in. Um, there's a lot of but a lot of question marks out there right now. So I think it's a little tougher call. But I tend to agree with you. This feels more like 2010 than it does 2008, 2007. So I do
Oh,
think
that's
there's opportunity.
interesting.
Yeah, I
Yes,
do
you
think there's opportunity.
Okay, okay. So let's talk about that opportunity for a second because I do know a lot of people who are struggling with, especially when the interest rates changed. A lot of that's getting flushed out now or has already been resolved or what have you. But interest rates are still relatively high enough to the fact where people can't. Um, I'm in two properties right now that need to be refinanced and can't get refinanced because of
Right.
the interest rates right now. So, um, what should investors be focusing on right now, knowing that the interest rates aren't ideal? They're certainly not the worst that we've ever seen them, but they're not ideal.
So, and again, I kind of focus on the institutional space. So I don't know, what everyone's seeing, but we're kind of seeing rates around kind of all in around 5.5.
Okay.
For but you've got 80s deals that are probably trading at six caps.
Okay.
But no one really wants the 80s deals. But a lot of what's trading right now is the perfect. So you'll trade at 5.25 to 5.5. So the deals, your low leverage, the deals can still get done. At the institutional space, they're not taking as big of a gamble on the debt.
Okay.
When I was doing deals for my last position, we were doing sub 50% loan to values, 155 covers. So we were sometimes in at only 35-40% loan to value. So it just wasn't as significant. So you could go out and you could be a little more aggressive.
Oh, interesting. Okay. So, but your cost of capital, if you're going in with institutional money, how much is that institutional money costing you?
Well, you're still you're still. I was working for funds, so we were we were trying to churn out a 7 to an 8, and we could do that with the low leverage. We could juice it enough to get the returns that we were looking for.
Okay.
It wasn't really a cost of capital. It was more of what we're trying to get on the back end. We're trying to churn out a cash on cash over the term about 7 to 8.
Okay. So your cash on cash is like 7 to 8.
Mm-hmm.
And then what is your
Just
IRR looking like?
I'm sorry, unlevered IRR 7 to 8
Oh,
is, is,
okay,
is
okay.
what we were shooting for.
Oh, okay, okay. And so then all right, that's interesting. Okay,
Yeah.
so, um, so how do you to me, that's like a lower return. But I'm
Absolutely.
guessing, are these properties that are cash flowing immediately?
Oh yeah. Oh yeah. No.
Okay.
Yeah. At that level, there's not a lot of creativity. You know,
Right.
there's you're cash flowing today. You're going in low leverage. You're cash flowing out of the gate. You're doing at that position in particular. We weren't doing big rehab plays. They weren't what we called. They weren't very disruptive. We were looking. It was kind of core plus type opportunities. It wasn't. We weren't coming in looking for high teen IRRs or anything like that. It was just. It was just day one. You're cash flowing. You're looking for an unlevered 7 to 8, which back then we were doing more of it then than you would today. But that was typically the goal. Would be a portfolio goal as well. So not necessarily a property goal. You're looking to
Okay.
reach that on the portfolio.
Okay. Okay.
So
So,
you'd have some
yeah.
that were winners. You might have some that are losers, but you're trying to hit that sweet spot.
So let's talk about that for a second, because to me, losing hurts bad. Hurts in a major way. So let's talk about that. Like, how do you get over the losses? Like, what do you do? How do you cope with that? How do you come back from that?
Well, so in the bigger picture, depending on who your source of capital is, it's kind of like dollar cost averaging. That group, whoever they are, pension fund, uh, insurance company, they've decided they're going to be buyers of real estate, and in the long term, real estate, they want to be there. So you're going to buy here, you're going to buy here, you're going to buy here, you're going to buy here. So no one wants to lose on a deal, obviously, but they are portfolio minded rather than transaction minded. On specific deals, they're no different than anyone else, except again, timing and we're underwriting 7 to 8 year terms. So the time pressure really isn't as significant as it is on a 3 year. Most of those short term transactions that were getting done a few years ago were 3 year deals. So you had to be in and you had to play everything perfect and you had to be ready to be out in 3 years. We're underwriting 7 to 8 year holds, 10 year debt. So we just weren't really under the gun. I mean, are some of the properties worth less today than they were when we bought them? Yeah, yeah. But it's not really worth that until you make that next transaction. I mean, does it feel good to go to the broker and get the BOV that says your $65 million deal is worth 45? No, it's not. But it's not really worth that until you sell it for that. So you just work through it and you continue the operations and you're well capitalized if you need to be, but hopefully you don't have to make decisions when things are bad. Now, if you're now,
Okay.
there's a lot in the
Yeah.
news today about the guy, 3 year deal. You could be perfect. The market turns against you and you're buried. There's no way. There's no way to come back from that. If you're perfect, there's no way to come back from that because the market just worked against you. The market worked against us. Some of the better deals it worked against less, but there are some deals that are $65 million deals worth $40 million today. And yeah, that's you've got to explain that, but you're also explaining it on a portfolio wide basis, not necessarily a deal by deal basis. As long as you don't have to make a decision on that deal today, you do what you can to keep the property running and keep the operations improving. And you don't. I mean, it's just like the stock market, as they say, you don't take a loss until you do a transaction.
So okay, but let's back up for a second, because I bet a lot of people who are listening to this now and they got a nice little portfolio for themselves, and they would like to get institutional investors or pension funds or things like that. How can they position themselves to get in front of those institutional investors and get them interested in their deals?
You you need to show success, obviously. That's pretty easy. But I
Mhm.
think you need to show a repeatable system. Like I said, we had a box.
Okay.
If the deal fit in the box, we looked at it. If the deal didn't fit in the box, we didn't look at it.
Mhm.
I think on the institutional side, there's more quantity as opposed to creativity. Um, you're I want to tell my investors this is exactly what I'm going to do, and I'm not going to stray from that. And we're going to repeat it, and we're going to do it over and over and over and over again. And you need to have systems
Okay.
in place to ensure that. And you own, if I'm not only, or if you go in another direction outside of that system, everybody needs to be pretty clear that why you're doing it. If you're going against the business plan, it needs to you need to send up flares as to why you're doing it. But really it's repeatable and it's quantifiable, and you can just churn. You can do it over and over again, and you're only doing a couple a year. Even some of the biggest groups, they're not, you know, 2 or 3 deals a quarter. Maybe they're doing, maybe more, maybe less. But the key is just to have systems in place that are repeatable. You never question what you're doing because you never go outside of that box. I've been I've been in situations where the map is this. I had a deal right here. It was outside of the box. Then we have to decide, are we gonna take the time and the energy to explain why we're going outside the box. Someone else, it might say, well, it's a couple blocks away. Well, if it goes bad and we went out of our way to do a deal that went bad, that's a tough pill. But if everyone has the same hypothesis in place and you're just sticking to that, it's kind of CYA. Look, we've got this plan. More times than not, it makes money, and we'll keep going. And you got a deal every once in a while it doesn't work. It's just, again, it's dollar cost averaging.
Okay. Yeah, but so you don't blow up the box because one deal doesn't work, is what you're
Right,
trying to
right.
is that
Well,
correct? Like,
yeah, you
how do
can
you pivot
improve the
from that?
box. If there's a reason to
Okay.
improve the box, maybe you do
Mhm.
that. Um, but if you go outside the box and that deal doesn't work, and you kind of staked your claim on going outside the box that's where it gets painful. But if you've got a plan and you run with that plan and you have success over and over and over again, and then you've got an outlier, there are outliers. It's just obviously limiting those. And again, you're
So
not you're
it's
not
just
you're playing long term.
right.
You're trying to not let short term um, conditions affect your long term game. These are 7 to 10 year transactions. So obviously, part of the play is we're going to get through this, and in 4 or 5 more years, things will be back to normal, and we'll be fine. But you've got to be well capitalized to get through those downsides as well.
The question, I guess, is, so what is the box? So I have a question here, from a viewer. What is the box? Like, what is the box that you have for your deals? What I hear you saying, let me follow up with that real quick.
Mhm.
What I hear you saying is you um insist that no matter how big or small you are, you create your own box and you say, this is my box. We can call them boxes, we can call them
Yeah.
underwriting requirements, whatever they are, but you don't want to step outside of your own underwriting
Well, it's your
requirements. I think
expertise.
this is an amazing idea.
Yeah, it's your expertise, right? I'm a
Mhm.
Colorado. I've been in Denver multifamily for a long time. We'll just leave it at that. Um, that's obviously a pretty well-defined box for me. I mean, people see me as a subject matter expert. Now, your subject matter
Mhm.
might be, you know, a certain square mile of a certain location. Um, but everyone comes up with their own box. It's what you're the expert in. The firm I'm talking about in particular, we were looking for some value add, but not big value add. We were looking for good markets, a huge thing, good schools, big thing, good schools. It, we weren't cracking atoms over here. I mean, it wasn't really groundbreaking. Good real estate, good location, good schools, jobs, population growth, and generally 80s or newer. Um,
Mhm.
I'm trying to think if there's anything I skipped there. Good real estate nearby. You're in good location. I mean, it's not rocket science. We weren't.
Mhm.
It was
Mhm.
what it was it wasn't it was probably slightly less than what they would call core plus transactions, but it wasn't 80s
Mhm.
transactions
Mhm.
either. So it was what everyone wants. 90s in the institutional space, 90s and newer is kind of what everyone's looking for. And
Okay, so, that's interesting. So they don't
mhm.
wanna touch the older buildings.
Oh no, again, those are more creative. We don't want to be creative. We want long. You want what people want today. Dishwashers, washer and dryers. So can get that in an older asset, that's what you're looking for. That it's what we're really today. What's tough is 80s assets. They might have the shorter ceilings. They don't have washer and dryers. What some entrances can be not as appealing. It's those are kind of struggling right now. But a 90s deal is pretty similar to a 2015 deal in construction. So it's still what people want, but obviously, you're looking for well located transactions similar to that. That have what people are looking for. Now, your box might be 80s deals. I mean, if you're the 80s deals person, now's probably a pretty nice opportunity. If you figure out the systems and develop your plan for buying 1980s construction, I mean, there's a demand, there's opportunity right now. Now, most of the real estate, and again, institutional space isn't going in that direction because institutional's not looking for creative. They're looking for repeatable and consistent. And if you're looking at an 80s deal, you probably have to change your plan every time because you want to make that 80s deal as nice as you can for today's renter. And as today moves on and on and on, that gets more difficult. So you have to get more creative in order to make that work. Institutions don't want creativity; they want quantity. Let's repeat it over and over again, and good quality real estate, but we don't want to go too far out there to grab something that may or may not work.
Um, okay. So let's talk about location for a second. Where should you stay out of? Like what location should you stay out of? And 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 to follow up on the 80s versus 90s, is there a deal size? Is there A class, B class, C class? What are we looking at in terms of classes of buildings? What should we be looking for, or does that even matter?
I think that changes over time. Um,
Mhm.
Location. I think it's one of those things you know when you see it. I mean, do you want to be there? Is it a location? All of these institutions are using data that drives their decisions, and you might be sitting in a location that seems fine, just visibly, but the data doesn't drive it. So visit from a visual point of view, you know it when you see it. But then you're crunching numbers to see, are there jobs, what are the schools like, um, long term operations, short term operations. Uh, One thing we did a lot was institutional capital. Um, are the institutions, are they putting money into those areas? So investment outside into those. Does the rest of the world believe in this submarket as well? Honestly, one of the best performing submarkets in Denver, um, by the numbers, not a chance we would ever buy a deal there. Never in a million years could I get someone to buy off on what their data was telling me was one of the best performing submarkets in town, just because it was 70s, it was 80s, 60s. They were at the time they were seeing big rent growth, so it was performing well, and there was a lot of retail, so there was institutional presence there, but it wasn't our property type. So you drove through it, and never in a million years would we buy real estate there. But our data is saying this is where we want to be. So
Oh, wow. Oh,
you're
wow. So how are you pulling this data though? Like what are you looking at? Are you looking at population? Are you looking at the schools? What are you looking at?
all of that. So the funny thing is as you're, like I said, on the institutional side, it's less subjective. I didn't do rent growth. Someone told me what rent growth. You pay economists, and they're looking at Denver, and they're looking at the long term rent growth, and they're looking at new construction. I mean, the institutions pay people to, more or less have other people to blame, if things go bad. One of the biggest things an entrepreneurial person's going to worry about is rent growth. I'd have people come up to me all the time. What are you using for rent growth? Generally, I didn't know, because my model, I knew, but I wasn't manipulating it. The institutions they've got this information, and they decide, they put their heads together. Denver for the next 3 or 4 years is going to have this rent growth, and that's what you got to use. If I knew, a big factory is opening up next year, it doesn't really affect me. Hasn't happened. I'm looking at the data, and by the data, you're looking at the CoStars of the world, Axiometrics, what else? Yardi Matrix. So those data providers, and guys, guys that I never even met were making those decisions, based on 30,000-foot views of the market.
Oh,
Again,
okay.
it's not creative.
Yeah.
It's 30,000 feet. There are times when I was the expert that I completely disagreed with what we were doing. But
Mhm.
again, we're repeating the system. The system works. We're not going to change anything for a specific deal. So that's you work, the Yardis, Axiometrics, CoStar, every one that you've heard of before, and you develop processes based on that data. Now, maybe you're not buying all of them. Maybe you're using Yardi, but I think you want to be consistent, because you don't want to change your process for every single transaction. To me,
Right.
that's the key, um,
Right.
because then the brokers believe in you, and the market believes in you, and I don't think anyone wants to hear, we're doing something different every single time.
No. Oh, yeah, I couldn't agree with you more. So, but let's okay, so you create your underwriting requirements. You say we look in these submarkets that reach this criteria, and then these properties that have this vintage. Let's talk about lift for a second, because
Mhm.
we started off this conversation talking about how you're looking for these properties that don't require creativity and, are gonna cash flow.
Not be disruptive, is a, we're looking for something that's been done. We're not necessarily looking for, I'm not stepping out there on the ledge, to be the first guy that does whatever, adds washer and dryers to a 70s vintage apartment building. We want to
Mhm.
be able to see that it's done. So if I'm doing a rehab, and again, it's not going to be, it's more than lipstick, but we're not gutting it. I'm looking at the comps. I'm proving up rents. I'm doing everything that everyone else is doing. I'm just, but as far as, so that's one of the big things that is subjective. I should say it's not subjective, but I have influence on it. I mean, I can, I'm not going to say 3% every year, 4% every year. That's what my rent growth is, because my data is telling me what my rent growth is. But I can get $125 a month extra on this rehab. Yeah, if I can prove that, that's something where I've got the opportunity to influence the transaction a little more. There are items that have the ability, that I've got the ability to be more aggressive with, or to make changes to. But again, I'm not really being aggressive. It's hopefully what the market's telling me, as opposed to,
Okay.
the local market guy might say 5% growth for the next 5 years. Our model might be 3, and I could have all of the data in the world that says 5. We're going with 3 because portfolio wide, this is how we do it. So I'm not going to go out of the box for this one deal, because again, that's when you make your mistakes, is when you it could be a home run, but if it's not, you told your investors this is how you do it. You went out of the box and then failed. That's obviously a big problem. You fail inside the box, it happens. Every deal's not perfect. So you just want to keep as consistent as possible. Now that doesn't mean you're consistently using 3%. I mean, the the rental increases in Boston might be 5%, but you're using the same methodology to get there. So it's not across the portfolio. We're saying 5% rent increases. It's not like that. It's just we're using the same data in Denver as we are in Boston. Boston might say 5, Denver says 3. I'll use 3. Our Boston guy will use 5, but we got there the same way. Does that make sense?
Mhm, mhm.
So it's not that tight where it doesn't take into account the market, but just how you get there is what's important. Your process is the same over and over and over. I'm not going to bend my process in order to get a deal that doesn't fit.
Okay, okay. So okay, so let's just talk about your process for a second.
Mhm.
Did your process require any rehab? It must have required some
Oh,
rehab, right?
generally, yeah, yeah. Again, but again, what we called it would be not disruptive, and
Okay.
we're not going in and turning. We're not trying to make a C a B plus. We're trying to make a B minus into an A minus, and we're not trying to make properties something they're not. If there's a proven rehab at the property, that's obviously pretty easy. We'll continue with that. If there's properties in the sub market that are doing rehabs and getting opportunity, finding growth there, we'll do that. But it's just not a big lift.
Okay, okay. So let's talk about the growth rate. Are you seeing, when you were talking about your growth rate models, were you talking about 3 to 5% per year or over the 5-year period?
Oh no, I'm talking annually, but I'm not being specific about any. Those are just numbers I threw out there. Um,
Okay.
Three, whatever the what we would do is we would kind of be specific about years 1 through 5, or 1 through, 1 through, you're using sources. Maybe they'll give you the next 5 years anticipated rent growth. Beyond that, you use long-term averages.
Okay.
Something's, you're not going to guess something that far out anyway. So if you say, well, Denver's generally seen 4% over the last 20 years, so maybe that's where I'm at years 6 through 10. My sources, if they, again, depending on how I develop them, might give me something else for the next 5 years. There's a lot of, for instance, right now, there's a lot of construction. So my rates of growth today would not be anywhere near what they were 2 or 3 years ago. There's 17,000 units just came out, and there's another 40,000 in the pipe. So the next few years are going to see smaller growth rates, probably in the 1 to 2%, 2 to 3%, but definitely smaller than the long-term averages.
Okay. Okay.
So I'm taking data. Someone else, with the economist or a PhD at the end of his name, is deciding what to do with that data, and we're developing, our underwriting based on that information. So it could be as easy as we have 3 sources for the next 3 years. Each one says A, B, and C. Let's take an average of A, B, and C, and that's year 1, year 2, year 3. Now, that's the easy way. That's easy math. But if it's consistent, that's what people want to see. I'm sure we were definitely looking much deeper than that. But you're taking many sources of data and compiling them and reviewing them and deciding, based on your best guess and your belief in the markets, this is what growth rates are going to be. And you're only going to, chances are you're wrong. I mean, well, you're going to be wrong. It's just a matter if it's in your favor or it's not in your favor.
So if I'm a smaller guy, let's say we're not institutional, we don't have the economists and the people with the PhDs and things like that. Just give me like 3 numbers or matrix that you would, or matrix, excuse me, metrics, 3 numbers or metrics that you would use. Like these are your 3 go-tos to analyze a property or a market before going forward.
So I would invest in some data source.
Okay.
First of all, I mean that your metrics, if you're pulling them from all over the place, are not really useful either. But if you're consistent, I think that's where it has more meaning. If you're going out and investing in Yardi Matrix or CoStar or Axiometrics or whatever, and frankly, invest is probably even the wrong word. I mean, Marcus and Millichap, their market reports, but just be consistent. I'm always going to use this. I like this deal. I'm going to use this source. I don't like this deal. I'm going to boost this deal. Let me grab this resource. You just want to be consistent about what you're doing. So you want groups that are, supposedly looking at this really in depth to be giving you your information. And then you're going to decide what you're going to do with it. Rent growth is the big one. I mean, look, I mean, you can make any deal work with the right rent growth, right? And the right expenses growth. You need to take that, what we would do, take that out of my hands. I'm an acquisitions guy. I get paid to do deals. I could do every deal that was out there. If give me enough freedom, we'll just have deal parties and we'll. But when I've got to do deals based on what Yardi Matrix is saying the rent growth is for the next 4 years, and our company believes it's X amount of dollars to run a property per unit, and I'm going to stick to that. The goal was to take as much out of the variable stage as possible. Rent growth, expense growth, take it out of the acquisitions guy's hands. Our management team believes we can run this property for X dollars a unit. because they got to do it, and
Okay.
so I can't say you can do it for 7,500 when they're saying you got to do it for 8. The smart people say it's going to be 8,000 a unit. Okay, I lose. I'm not going to go to an investment committee and try to explain their business to them. So if you're a entrepreneur, you've got a management company, what's your management company say? Now, there might be reasons at a specific property why it's more expensive or less expensive, and you can make that argument. But at the end, everyone's got to agree. The acquisitions guy gets paid to do deals. I do a deal and then I give it to the management folks, but how I underwrote the deal doesn't match how they're going to manage the deal. The deal's not going to work. We could get lucky, but if I say it's $7,000 a unit and that gets me my deal, and they're at 8,500, the deal's not gonna work. So everyone that has a hand in the operation of the property has to be in agreement. So I'm talking to the economists who are telling me what the rent growth is going to be, and frankly, I can't argue that. It just is what it is. I mean, and I've had stupid the stupid reasons why they were completely wrong, but I got to stay in the box. I could make an incredibly strong argument against some of the things they were telling me to do, but then we got to go out and explain to the investors why we're going out of the box, and a lot of times it's just not worth it.
Oh, I see. I see. So in other words, we set up this metric. We said we were going to listen to these people. I think these people are wrong, but because we set it up where our system says we're going to listen to these people and to this data, we can't go outside the box. So you probably rejected far. What would you say your ratio is, like 80-20, 90-10 on rejections versus
I
deals you
lose no
actually
matter
did?
what. I lose no matter what. You want to go to your investors and say the guys that you've based all of your investment decisions on are wrong.
Yeah.
So
Yeah.
so that's not a good place. There's a perfect in Denver. I-25 splits Denver, and down south you've got the Denver Tech Center. Denver Tech Center kind of covers, it's kind of I-25's here. Denver Tech Center is on both sides of I-25. Well, our group, looked at this side different than this side. This is really Denver Tech Center. They're calling this Denver Tech Center. They're calling this something else. This is the Denver Tech Center. They're clearly wrong. They're on the 90th floor of some building in Manhattan, but they're that data just stays consistent in our world, because if we say there's a flaw in it, we could go out and again re-underwrite every transaction differently, and the goal is to have a portfolio of transactions that were underwritten consistently. If I go out and question every transaction, then you don't have
that. Okay. So so this just makes it so when you know a deal is good, that deal is good. There's like almost no doubt, right? Like, so you can just go in with such like a level of confidence like no other.
Right.
Okay.
But that also means, there's not there's not a lot of vision. I mean, it is what it is before we even so let me tell you a quick story. So when I started in brokerage, I worked for two guys. And one guy kind of focused more on the institutional space and was very good at it. And the other guy focused more on the entrepreneurial space and was very good at it. And he used to always say, don't get in the way of the vision, because he would change stuff. I'm not looking on the institutional side. There is no vision. It's all on the four corners of the pro forma, and it is what it is. And really, institutional investors never talked to this guy over here, and mom and pop never talked to this guy over here, because they spoke different languages. It's just a different conversation that you're having. It doesn't mean that the mom and pop are wrong. I mean, it doesn't mean the vision is wrong. I think that means there's an opportunity there. You're not going to compete with the big boys because, you can open your eyes a lot further than they can. You can see opportunity that they're not allowed to go after. Again, I mean,
Okay.
if a property was outside the box by a hair, then if I chase after that property, I've got to kind of defend the box. Is our box wrong? Because we're not including that property. So you don't do that, and this assumes there's enough business in your box to run a company. I mean, if there's not, maybe, or the market has adjusted. My box doesn't work anymore because the market has changed. I can't get the returns I'm looking for, and maybe you have to adjust your box because you can't, you can't support an investment thesis in this box anymore because the market's changed or the world has changed. There's nothing wrong with that, but it's got to be done with a portfolio. It's got to be done consistently, the same way it's done in Boston as it's done here. You can't go to the 95th floor somewhere and say, we're going to underwrite Boston deals like this, and we're going to underwrite Denver deals like this, and LA deals are like this. There's no consistency there. I mean, the whole thing about the institutional world is there's consistency in what they're doing. And again, it's quantity versus, your one deal your vision might absolutely be true, but you're living down the street from it. You're managing the hell out of it. These guys are in California managing deals in Atlanta. So it's just a little different thought process. I'm in Los Angeles or Irvine. Irvine, everyone's in Irvine, right? Can I manage that deal in Atlanta the same way I can manage a deal in Irvine? Probably not. Now you can have vision because your deal that you just bought's down the street. So there's opportunity there that it's just more risk than the institutions are willing to take on.
Yeah. Okay. So, again, I hate to circle back around to this, but I do know people are going to be like incredibly interested in, if I want to get institutional investors involved, besides my success matrix, are you saying that I have to be incredibly boring as well?
Yeah, I think so. I mean, it obviously depends on your source of capital and what type of, what their goal is. I mean, maybe there is some, there's some investment bucket out there for vision. Yeah, they're not looking to be very disruptive. They're not. It operates again like a machine. It doesn't. There's no big swings left or right. I hate to sound boring, but yeah, I mean, you're doing the same thing in Atlanta as you're doing in Dallas as you're doing in Seattle, and it's working and it's repeatable. Doesn't mean the deal down the street from you isn't a home run, and your business plan is absolutely correct. It just means it's a different type of investor. And I'm pretty boring anyway, I guess. So.
Yeah, because I'm thinking right now, like I'm doing 2 deals that are, they're not condo conversions, excuse me. They're hotels to apartment conversions. Like a lot of cities right now are in need of housing, and they have, this glut of hotels that aren't performing well. So, we do have to do a conversion to them in several different ways, but I fail to see why institutions wouldn't want to get involved in that
Oh no,
because
and they probably are.
that's a need.
Yeah, and they probably have buckets of money It depends on the institutions you're looking for, and you're working with. I'm sure there's money out there for those conversion opportunities. Now personally, I've not, they
Mhm.
don't strike me as, I just haven't seen a lot of them executed very well. But are there people out there that are investing money in that exact opportunity? Yeah, but I guess think of this. If you're working with pension funds whose goal is to take care of the policemen or the firemen or whoever the pension fund, do you want boring or do you want exciting? Exciting, those guys, I don't know that they get paid for excitement. You want, slow and steady wins the race. Again, unless your fund looks at it differently, and I am absolutely sure there is, but in most cases, it's, we're real estate investors over the long term. We're not looking to recreate the wheel in 24 months. So we're not
Mhm.
looking at
Mhm.
anything that's too aggressive. I mean, most of what we wanted to buy is nice, newer, pretty. You'd want to be there. There's not a big there's not anything too exciting about it. Exciting, probably. I mean, if I lived in an apartment, the last thing I might want is exciting. And so you're getting opportunity. You're underwriting transactions that still have some upside, um, but they're less exciting. In Denver speak, Greenwood Village is a lot less exciting than Aurora. Um, if my money's invested in the long term, what do I want? I can probably get higher returns in Aurora, but
Oh, I see.
do I want slow and steady wins the race, or do I want to have to, again, all of these deals that you're reading about now that haven't gone very well, they were on 3-year short-term debt where you got to be perfect. Do you want, I mean, is it perfect or bust, or slow and steady wins the race? And pension funds tend to be more slow and steady wins the race. Let's buy good real estate in good locations, and we'll go from there.
Right, right, right.
There's always look. We did both, so but even our value add world wasn't very sexy compared to some folks out there. It still wasn't quite as aggressive as the market. We didn't do a lot of it because it wasn't. I couldn't get the returns that our group wanted the way that we underwrote deals. So I couldn't get rocket ships.
Mm.
So we were kind of core plus investors. If we found a good
Mm.
opportunity that was value add, we would do it. But I could, in Denver, the return hurdles were just too hard to meet based on our investment requirements. So yeah, I don't think going back to the
Uh,
original question, I don't think if you're investing with institutional partners, I don't, you've got to have just a proven system that is completely repeatable. Um, whatever you're doing, even if it's value add. I mean, when I got into brokerage, I did a lot of deals with Bascom. Bascom's, done incredibly well, but their system again is just repeatable. It's value add and it's big returns, but it repeats, and it's the same thing. Bridge Investment Group, uh, their system is so structured, and I was in it for a little bit. You're just repeating. They don't go outside the box, because then they've got to, again, then the validity of our entire investment thesis, is a question if we have to go outside the box.
okay.
A lot of talk
Okay.
about boxes.
Yeah. I know. But I think what we can learn from this is that if you're gonna go out there and you're gonna do deals, and you're gonna do deals at this time where, it is very 2010, but there is no guarantee of automatic success. I had plenty of people who bought in 2010 and were going bankrupt in 2012. So there
Yep.
is no I wanna be very clear to people out there, both Ray and I have been in real estate since 2004, 2005, went through that cycle. And just because you get through 2008 doesn't mean you can just go crazy buying whatever you want and expect another 2021. It doesn't work that way. You still have to make things work. So what I'm hearing you say, based on everything we've talked about today, is that it's crazy important to have underwriting criteria and then to stick to
Stick
that
to it.
underwriting
Yeah.
criteria, whatever it might be.
Well,
Maybe
it's
you're not doing, boring vanilla, multifamily. Maybe you're doing something a little more exciting,
mhm.
but whatever that criteria is for that thing that's a little more exciting, you have to have that criteria and stick to it.
Well, and it's beyond. I mean, you might consider due diligence underwriting. You might not, but it's the same thing. I mean, your systems can't
Mm.
they they can't change based on the transaction. So
Mm.
your underwriting, um, or I'm sorry, your due diligence. If you can't, you do the same thing on property A as you do on property B. Now, maybe you do more on property B because there's a reason, but you're certainly not going to do less. A
Mhm.
is your baseline, and this is our system. Now, if B gives us a reason to think there's an issue, we do more, but we don't do less than A. I mean, A's baseline. You can always do
Mhm.
more due diligence. You don't do less. Underwriting is the same way. I'm not going to. This is how I underwrite a deal, and I underwrite every deal that way. And again, it's not the inputs might be different, but the sources are the same. Because again, 5% in Boston might be the same as 3% in Denver. They're the same numbers, so you're not. And it could be market to market. It could be market to market in Denver. I mean, maybe this sub market over here is 3% growth. Maybe this one over here is 4. As long as you can justify it, and your system, that's how you always do it. That's what investors want to see. I'm not changing because I got to get a deal done.
Mhm. 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 That's huge. That's huge.
I
Like, I'm not
we
changing my criteria because I gotta get a deal
Right,
done.
and that's the institutions are
Yeah.
they're in New York somewhere. They're writing you a check based on what you said you were going to do. So you can't. A lot of institutions say, "Look, I'll give you a little rope if you need, if you need to go outside of the box. Um, here's the process." No one's really too excited. That's just extra work to
Mhm.
justify the deal. Um, but it's not something that anyone is too excited in doing either, because it just the more times you go to the well for, hey, this deal's great, it's out of the box, because, well, then the more of that you get, the more you have to wonder, well, maybe my box isn't correct. Maybe my buy box needs to be changed.
Mhm. Yeah, yeah.
Because
Yeah,
if
that
every deal is
that makes
great,
sense.
if every deal outside the box is wonderful, then why aren't they in the box?
Mhm.
So,
Mhm.
um,
Yeah.
and again, eh, underwriting, due diligence, you do the same or more. If deal gives you a reason to think I need to dig deeper, you dig deeper, but you don't look less. So again, you got a baseline system. That's what you do. You do more if you have to, but you never say I'm going to do less on this one because I think it's a better deal. I mean, we've at places I've worked, you do the same process on a due diligence on a Class A deal as you would on a C deal. Now, the C deal, probably you're going to have to increase it, but you at least have to meet that base level. I,
Mhm.
you
Mhm.
know, I've worked for companies that have to get in every single unit. It doesn't matter.
Yeah.
We've drilled out locks. We're getting in every unit, And then I've worked for others that say 95%. Okay.
Yeah.
But the reason, the reason one is getting in 100 units is because they got burned, at some point. I mean,
that one unit that had hoarders in it.
No one wants to fight to get in that last unit because it's the end of the day, and we're ready to go home. And the last thing we want to do is
walk every unit.
Right.
I
The
walk
last thing
every
you want to
unit.
do is pull a drill out to break into this person's home, essentially. But you gotta do it. So
Yeah,
you've gotta your baseline has to be structured, and you can't go below that because that's what you've promised the institution you're going to do.
Yeah, I mean, and that's huge because you lose that, you break trust there, then you lose that lifeline. Well, Ray, we are out of time, but I want to thank you so much. Guys, if you're watching this after the live stream, please continue to ask questions in the comments below because we will answer them for you, and or perhaps do another live stream where we answer them for you. So ask your questions, make your comments, let us know what else you'd like to see on this program. That my guest today was Ray White. Ray, where can people catch up with you?
Let's see, email White or Ray.White at innermountainmultifamily.com. It's probably the best way. I'm on LinkedIn as well. I don't know what my LinkedIn is, but search Ray White Multifamily. I'm probably the guy. That's probably the best place.
Awesome. So guys, reach out to Ray. He's a wealth of information. You never know what you guys could partner up and do together, or if you need some advice, he might just answer your questions for you. So look for him on LinkedIn, and also his information is in the comments there. We'll put him in the liner notes as well. Thank you so much, Ray, for joining us today. I'm Jillian Sidoti. This has been Entrepreneur, and we'll see you next week at the same time and the same place.